Good morning and welcome everyone to the Money Control live stream. You're watching Markets with Santo and CJ. Well, today morning we have the focus on the capital goods sector with Siemens India yesterday coming out with their Q3 numbers. Santo, what did you make of it?
Well, good set of numbers, CJ. I know you've always been skeptical of the Capex story here, but as you can see from the Siemens India stock, over the last month or so, the last couple of months, the stock has been one of the outperformers in the market. Good steady appreciation. They're kind of showing that the market is really betting on that, and the company has not disappointed as far as its third quarter numbers. It follows an October to September financial year. That's why this is the third quarter, and the numbers are pretty strong. Growth not just year on year, but also quarter on quarter. The margins have been a bit of a concern. That's only expected because it's not just particular to Siemens. We are seeing that across all capital goods companies. But the good part is the order intake. Close to 5,000 crore of order intake. In fact, they had a very big order win in the mobility segment. That was that's what boosted the overall order inflow for the month. And the overall order book stands at close to about 18,000 crore now, which is also pretty fine. Most important is the management commentary, which said that so far they have not been seeing any signs of slowdown in either private sector or public sector Capex spending. But yes, he's also cautioned at the same time that global headwinds, probably could be a source of concern. But that said, at this point, the market seems to be pretty confident that the company can deliver, and you're seeing that the way the stock price has been performing.
Well, Santo, I think the capital goods space has probably been one of those rare sectors where actually FIIs and DIIs, your mutual funds, have both been quite bullish throughout the year. If you look at the flows that have been coming into the country, actually capital goods is one of those sectors which have actually seen positive inflows from the FII category over the past quarter. So clearly I'm not surprised by the stock performance so far, but I don't think the the Q3 numbers that have come out or June quarter numbers that have come out merit that optimism as of yet. Why I say that is because if you look at numbers across the board, yes, on a year-on-year basis, they look quite great, but they're actually below par, except for the revenue, metric. Net profit were below estimate, EBITDA was below estimate, and margins were also below estimate. And I think margin is, of course, the main focus here, because basically what it is showing, and this is something that Siemens had also warned previously also, Santo, you must remember, that execution risk is the biggest challenge for them, right? Because of the fact that sometimes there are unavailability of certain imported, raw material that they utilize in their, manufacturing process or in their, production process, because of the chip shortage that we have already know about globally that has been ailing the automobile sector. I think clearly execution risk would be my biggest challenge or my biggest worry for Siemens India. Apart from that, of course, costs still remain quite high. Maybe we could see sequentially some improvement on the cost side, but margins at this point of time are a big concern for me. And if you look at the overarching theme, of course, Capex has been one story that has been peddling in the market for the past almost 12-13 months now, and everybody seemed to be optimistic on capital goods. But so far, I am not still seeing, that one telltale sign that yes, the recovery is here, the cycle has commenced, that the cycle is here. I think we are still in a very nascent stage, at least as far as domestic Capex is concerned. A lot of these capital goods companies have, gained a lot of orders and a lot of revenues from exporting capital goods. I mean, if you remember, FY22 was probably the best year for capital good exports for India. But I think globally also, as the management also mentioned, the headwinds with respect to a US recession, possibly a EU recession that we are seeing, I think that could moderate that side of the business as well. So I would be a little skeptical here on in terms of course, not only the margins, but as well as the revenue growth for the company.
Well, point taken, CJ, that there are clearly headwinds at this point in time. But for now, I think from how the capital goods stocks have been faring, it looks like market is willing to bet on them at this point in time.
Probably they are looking at the longer term. Maybe they are looking past the near-term challenges. Maybe that is one of the reasons we could have seen capital goods stock outperform. But I'm just a little worried that maybe the market is getting a little ahead of itself as far as the Capex team is concerned. Well, that's it, Santo. We should quickly take a quick check on how the trade setup is before we move on to the other stocks on our radar. Clearly, it seems like we are going to, continue the positivity that we had towards the end of the session yesterday. The XGS Nifty is indicating a moderately positive start for the Indian market. Cues from Wall Street, however, were a mixed bag. There was a very muted close or a muted session on Wall Street overnight. The dollar index rose. The US bond yields also rose. on the back of course, the uncertainty that has been created by, US House Chair Nancy Pelosi's visit to Taiwan. Now we have to wait and see what the response would be going ahead from China, but clearly this is one issue that has created another geopolitical, flashpoint between China and US, and in the back of what is happening with, Ukraine and Russia. I think this was something that probably markets could have done without.
Well, again, as I see it at this point, yes, we have seen a strong rally in the domestic market, mainly following global cues. But also point to be noted is that when prices move up, automatically investors tend to look at the positive side of the picture. They are almost cherry picking data when at the same time you can see some other pain points also. For instance, now the July trade data, it shows a record deficit. That also shows
and
some of
exports have actually fallen year on year.
Exactly. So that shows the that the macro picture, yes, we're better than most other economies at this point in time. Probably inflation is not as bad, and on a host of other indicators also we are doing reasonably better, but that still doesn't mean that we are out of the woods. But if you look at how the market is trying to price stocks, it seems to be projecting a very rosy picture out there. Again, with the US Fed also, they have said that they won't give guidance and they'll be data dependent, but markets, again, global markets are factoring in that a rate cut cycle will begin as early as March 2023. So probably we could have, you may be seeing a bit of too much optimism here.
Yeah, I mean, clearly, I think the main driving force for the past week of course have been the return of FPIs. I think the return of hot money, or probably the hedge fund flows from US has really driven the market here. And even yesterday you saw net buying from FIS side, and I think probably speculators on the long side would be betting on this flows to continue at least maybe another 2 weeks till there is something different, maybe in terms of US data, that changes the view.
Yeah, but then again, look at the first quarter earnings. They don't justify this kind of exuberance really. There is.
But they also don't justify pessimism as well, Santo. I mean, we have not seen major downgrades or upgrades in that sense. So maybe the market probably has to go nowhere in that sense.
Again, it's a mixed bag there. In some cases, there have been pretty sharp EPS cuts, at least like for instance, take Escorts. That's one, that was a very hot story till about a month back. Now suddenly, the street has turned bearish on that. Maybe going forward, we could see more of such things.
Well, Santo, let's move on to the other 4 picks on our radar, starting off with
Voltas, CJ. Now, I've been bearish on that stock, and this is one stock I see no reason to change my view. Stock stuck in a narrow range for a very long time. After the March quarter numbers, there was huge disappointment, sell-off. The stock rebounded from that when the company said that it was now able to claw back some of the market share it had lost. But now, as the June quarter numbers shows, CJ, that increase, that clawback of market share has come at the expense of margins, and that is something that the street is not really happy about. And CLSA is among the brokerages which has retained its sell rating on the stock, and also trimmed this EPS estimates for the company. Typically, June quarter is a seasonally very strong quarter, and the company has done well in terms of the top line. But again, it's the margin which is the bigger worry at this point in time, which means that even if the company continues to retain market share at this point, it will have to still take discount more aggressively. Competition is quite intense. So this is a stock I'm not particularly bullish on at this point.
I'm actually not surprised by the fact that margins are weaker in the June quarter. I mean, this was something that was going to happen, and I don't think it is solely down to the fact that the company was trying to regain a lot of the market share that it had lost in the room AC segment, and therefore it let go of margins. I think margins, of course, are also a function of course, the cost inflation that overall, consumer or white good companies have seen across this quarter. We have seen it in other companies' earnings as well. So it's not a surprising fact for me. The good part is, of course, that the market share that it had lost, it has recouped almost a majority of it. Now the market share is back again from 19% to almost 24% at the end of June quarter. So clearly that is one positive. As far as margins are concerned, I would expect margins to sequentially improve from here on. Of course, leave aside the fact that they want to gain more market share. That is a different argument. But just the cost, side of it, given the fact that we are seeing a lot of raw material prices come down, fuel costs have come down on a sequential basis. I think on a sequential basis, you could see some improvement on margins from here on. And I don't expect the company to be too aggressive in terms of regaining market share and also losing margins from here on. yes, the benefit for Voltas is that because it's an industry leader, it had that leeway to lose some of its profitability to regain the market share that it had lost, because I think regaining that market share was very important for the company. And overall also, I think these are just near-term headwinds for Voltas from a longer-term perspective, Santo, because look at the market. I mean, the room AC market is still a very under-penetrated market. The growth story there will always remain intact in a developing economy like ours. So clearly, if you can look beyond the near-term challenges, there is still a lot of value to be had here. That said, first stock on my radar today will be RIL, or Reliance Industries. I would expect the stock to gain today with the government, overnight making further tweaks towards windfall gains tax policy. You have seen the excise duty on jet fuel export being cut down to 0 from rupees 4 per litre. Earlier, you have seen the excise duty on diesel also been cut down to rupees 5 per litre from rupees 11 per litre earlier. So clearly, these two facts should be aiding the earnings of the refining segment for RIL going ahead, because these two, in particular diesel, is a major export product for RIL. So I think that should be a good positive for RIL, Santo. And overall, I think if you look at the Q2, how Q2 would be developing for RIL, I think you could expect the retail business to do really well this quarter again. We've seen a very strong performance in June quarter from the retail business, and I would expect a similar performance in the September quarter as well, given that there are no restrictions anymore and footfalls have clearly improved substantially for RIL compared to the pre-pandemic level. And lastly, I think the telecom business, of course, now comes into focus over the next 1 year with the 5G spectrum auction now concluded. Analysts and investors will be eagerly awaiting when the company launches, what will be the pricing around that, and it could be, the next big trigger for the telecom arm of RIL as well. So overall, I think the setup looks quite good, and I think valuation also are quite reasonable given the fact that the stock has taken a few, some weeks of beating over the past, I think 6 weeks almost. I mean, since the windfall gains tax thing came out, the stock has not really gone anywhere.
You laid out the macro picture quite well there, CJ. No dispute on that. Almost all the pillars seem to be in fine fettle. The only thing I would say here is that RIL has been struggling to break past the 2800 mark. It made a double top recently, and it almost seemed to be getting past that level when you had the windfall tax coming in. So from a trader's perspective, I think most people would be looking for the stock to cross 2800.
Yeah, that remains a crucial level.
Bullish on the stock in a big way.
Because if you know, the market consensus price target is somewhere around the 32-3300 range. So clearly, there is a lot of upside to be had. It just needs to break above that 2800 level, definitely.
Lemon Tree, the next stock on our watch list, again a big play on the reopen theme, and the June quarter numbers again have showed that this pretty much in line with what the management had been talking about. The March quarter numbers were good, and they said that June would even be an improvement over that. Now critical to watch will be the current quarter, given inflation and other forces. If the company will be able, if the hotel chain will be able to sustain that. But very clearly, with business travel picking up, I think companies which earn bulk of the revenues from the corporate travel business segment, they stand to gain. Lemon Tree clearly is one of them, and I think at this point the stock looks well placed compared to all its peers.
Well, Santo, you can't really argue against the earnings performance for the June quarter. I mean, yesterday it was Chalet, today it is Lemon Tree, and clearly both of them. And the overall hotel industry has done quite well in the June quarter. Of course, my only concerns are, of course, how much of this pent-up demand will continue in the coming quarter, especially in the wake of the inflation dynamics that we have currently going on in the country. And lastly, I think business travel bit is something that I'm a little confused on, because I think there is opposing commentary coming in from certain industries. You had VIP industry talking about possibly a slow recovery in business travel, whereas Chalet, as you indicated yesterday, is quite confident that business travel is going to come back in a big way. So an interesting stock to watch out for.
Well, with that, the market has opened a bearish start today on the Nifty, down about 25 points in early trade. But again, CJ, very strong demand for second line stocks. Advance to decline ratio is almost 2:1 at this point.
Yeah, I mean, it's a very, very, dead start for the benchmark indices, at least the Nifty and Sensex, very, very flat at this moment. But yeah, clearly the Nifty mid cap is also not doing that well. It's just a small cap space, I think, Santo, that is still holding the fort for the bulls. small cap index is higher by I think 0.2% if I'm not wrong, and I think that is why you can see it in the advances decline, where the advances are almost double the number of declining stocks out there. ONGC taking a knock at this point of time, down 0.7%, Coal India down 0.5%, Britannia down 0.7%. So clearly, I think the heavyweights or the frontline stocks not in favor at this point of time. It is a small cap space where a lot of the attention is being driven of investors. The last stock on my radar, Santo, is actually a chemical name, Deepak Nitrite. Well, the earnings are not really much to write home about. Of course, this was probably expected. If you look at the past 2-3 months of performance of Deepak Nitrite, clearly the stock had taken a beating. Also in light of the the explosion at its one of its plants. So clearly the setup for June quarter was not very good, and you can see that in the earnings. It is a weak, a miss across the board. But I think what probably investors might look past this quarter is the fact that margins probably will improve from here on, because a lot of the raw material costs for Deepak Nitrite is coming down. Also in the month of July, you have seen nitrite prices globally as well as domestically improve, so that should also aid into the margin picture and the EBITDA picture for Deepak Nitrite. Overall, the demand scenario remains quite strong for Deepak Nitrite. I don't think that has ever been an issue with respect to the macro demand scenario for Deepak Nitrite. So overall, a good stock, I think, Santo, a stock that has compounded a lot for investors over the past 5 to 6 years. And I think longer term investors will be able to look past the weakness of June quarter and probably utilize the benefit of the the recent correction that has provided.
Well, the poster boy of the chemical sector,
Possibly,
I would say, Deepak Nitrite, given that it's compounded so much and been a huge wealth creator. But that said, again, it seems to have run into a bit of rough weather at this point. The margins, that's as you said, that's a big worry at this point in time. The top line is growing, but you have two problems here. One is that the margins have been under pressure in this quarter, especially in its advanced intermediate segment, more than its basic chemicals. The second thing is, now we are slowly seeing, because of the demand, we are now slowly going to see increasingly more capacity come on stream, and I think that is what is going to be a problem for not just Deepak Nitrite but the overall chemical sector. The story has been quite good, CJ. The story has been.
But good. I think, Santo, I think chemical is probably one space in Indian chemical industry. I think the one place where actually Capex happening is a good thing instead of probably say, for example, a cement sector. Why it is a good thing is because globally, the biggest driver of production or supply for chemicals used to be China. Now, China, as we know, over the past 4-5 years, has been receding its feet or has been receding its presence when it comes to environmentally harmful sectors such as, say, steel, you have chemicals as well. So I think for Indian manufacturers, adding to that capacity is actually a sign that demand is very strong, and therefore these companies are trying to expand their capacity to meet that demand. So I don't think I would be too worried about that.
Well, we'll take a couple of viewer queries here. Jalendra Kumar wants to know our views on Vedanta and ONGC. CJ, you want to go first on that?
Well, Vedanta, I think at this point of time, definitely it seems like a more of a dividend play. And of course, with the prices of commodity falling, especially in the aluminium space and the zinc space, I think it's something that probably is a bit more iffy at this point of time, Vedanta. Yeah, if you're playing it solely for the dividend, maybe you can play it. But I think for me, I think the stock remains something. There are better bets in the metal space than Vedanta for me, Santo. What do you think?
Well, I would say that most of the negatives at this point seem to be priced in, considering that the stock had taken quite a bit of a beating, and the company management was on our channel last week, and they're saying that they're going ahead with their planned Capex, which shows the confidence in the overall commodity cycle.
Possibly. I mean, as far as ONGC is concerned, well, I think overall we have not seen too much of a deterioration in oil prices. I mean, still, if you look at ONGC, yes, last night the government has again raised, not sharply, but moderately raised the windfall gain tax on crude production. But overall, average realization for ONGC still will probably remain in that $60 to $70 per barrel range in light of the windfall gains tax. And I think earnings overall should continue to deliver. Also, let's not forget that ONGC also a good dividend play, given that as a PSU it offers a very lucrative dividend yield. So I think investors will probably not lose much holding on to if you have already had it. But yeah, probably incremental investment could be held as far as current situation is concerned, until unless we see some clarity on the windfall gains tax.
If you look at the last many years, ONGC has been more of a strategic bet. You really can't
it's
make money by
it's a very
money.
tactical.
Yeah, it's very
play.
tactical. You can't make money holding on to it for a longer term. That is the way I would look at it. Valuations are cheap, but the moment sentiment changes for the PSU segment as a whole, I think then again the stock starts to underperform. Last question from Revati. She wants to know our views on Tata Steel. CJ has been
Tata
the eternal
Steel,
bull.
of course, I think Tata Steel has surprised everybody. I mean, I think their earnings, June quarter earnings themselves speak a volume about the company and the trajectory that it is headed towards. Clearly, debt is coming down. Margins are still sustaining. I think you could expect a good recovery in margins as well as volumes in the second half. That is the commentary that has been coming out not only from Tata Steel but JSW Steel as well. And hopefully the government also withdraws the the excise duty that has been imposed on steel exports. Probably if that happens, I think we could see some bit of recovery in the steel space in the second half of FY23.
Well, we're running out of time at this point, and with that, it's a wrap on this edition of Santo and CJ. Thank you for watching, and do share your feedback in the comment section below.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again live at 3 p.m. with all the day's action. Till then, have a great trading session.